Good evening, everyone. Thank you so much for attending this evening's webinar presented by Marshall Reddick Real Estate Property Management Private Lending Powerhouse Group. I'll tell you, Marshall Reddick is one of my favorite referral sources, vendor sources. I've been working personally with them for a very long time. My name's Tony Watson. I'm here on behalf of Robert Hall and Associates, and right now is a very unique time in the world, as we all know. In 2020, thank goodness it's over, and we're ready to rock and roll in 2021. And I've had a lot of great conversations with my friends down at Marshall Reddick about where they see the economy going and what they see as far as opportunities are concerned on the horizon. So tonight I'm going to jump in a little bit to talk more about the power of Inc. and obviously some tax savings during times of economic uncertainty. And what's going on in the world and what potential changes on the horizon. But first and foremost, I wanted Marshall Reddick to come on and talk a little bit about some of their real estate updates and what they're seeing in the market, and obviously some of the great services that they offer. So I'll be back on in a second. I'm going to hand the mic over to Thomas. Thomas, I think that you're up, my man.
All right, thank you much, Tony. What a great introduction. And yeah, we've been working with Robert Hall for some time now. They're definitely a great referral source for us as well. They do a great job. So yeah, thank you everyone for carving some time out of your busy schedules to join us tonight to learn about the power of Inc. I'd like to introduce myself. My name is Thomas Ahola. I'm one of the advisors here at Marshall Reddick Real Estate. What do we do here at Marshall Reddick? Sometimes people are just signing in. We have some, returning customers, but Marshall Reddick is a full service brokerage, right? That means we have licensed realtors, we have a broker's license, we operate as any real estate shop would. We just have the added benefit of being investment minded and in multiple markets. We also have a private lending institution. Now that's also very creative, keeping it all as a one-stop shop for all of your real estate investment needs, bridge loans, swing loans, all that fun stuff that we all deal with in real estate. We also have a mortgage fund, which is a very interesting and different way to invest. I would highly advise checking it out on the webpage and looking into it. We also do property management. That kind of rounds out the trifecta of all the things you would need when looking for an out-of-state real estate investment company. This little mantra is really good at the bottom. We make it possible to purchase residential real estate in carefully selected areas of the United States. Our organization provides real estate brokers, contractors, property managers, and access to top resources such as lenders, CPAs, insurance agents, attorneys, and much more, like our friends at Robert Hall and Associates. Now, there's a little bit about me. I'm an advisor here at Marshall Reddick, as I said. I love working here. It's awesome to be a part of this team. It's a whole crew. We have our nice bullpen and bounce off all kinds of investment, communications, and all stuff like that. I'm a California licensed realtor. I have been since 2017. I've assisted clients both in-state and out-of-state for both residential and investment purposes. I actually do have my degree in real estate. It's not a fancy MBA or anything, but when I had went back to get my license, I realized that there was a college level course, and I went through with it and did all my required college level education. All right, here are some questions you can expect in a consultation. First and foremost, goal setting. Every large achievement starts with setting goals, be that small goals, large goals, short-term, long-term. We help ask those questions and identify exactly what it is that you're looking for. How? Evaluating your options, choosing, what type of investment vehicle that looks like, single family duplex, larger apartment building, just get you down that conversation path to understanding what it is you're looking for. When? Time frame. That's also a very big one. I've had clients who are waiting for some equity in a property they're going to 1031, and I've had other clients who say, I'm just waiting for the right property, and the right property shows up in 48 hours, and we close on their first income property in exactly 32 days. 30-day escrow, 48 hours of waiting for the right property. What? Setting your criteria. Criteria is very important, whether you're looking for cash flow, appreciation. We help you navigate what that is that your criteria needs to be set to. Where is very important as well. We operate in multiple markets, and Sometimes you have a personal connection to one market. Maybe you have family, or maybe you just like real estate in Texas more than you like it in Florida. But we help, again, walk you through those paths and ask those questions to help understand what that is. And last but not least, who? We introduce you to all the key players, whether, again, that be like our friend Tony here, or whoever else that might be, a 1031 accommodator whom we work with, or any of our local agents in the markets you would be interested in. Property management team, private lending, we just have all of the connections, and we've built our company in a way to be, like I said, a one-stop real estate shop. Markets Marshall Reddick operates in. Now, we operate in a lot of markets, highlighted or low-lighted here in the darker colors. We also have, in the green circles, Marshall Reddick brick and mortar locations in Los Angeles, Orange County, Fort Myers, Clarksville, Tennessee, Austin, Texas, and San Antonio, Texas. Now, what does that mean? And when I say brick and mortar, that means we have set up Marshall Reddick offices in these locations. So when you're looking, you are working with a Marshall Reddick advisor who's referring you to a Marshall Reddick realtor, and get set up with Marshall Reddick Property Management to keep it all under that professionalism umbrella and keep our quality high. Now, we don't just choose these markets by throwing a dart at the board. No, we've done years and years of research and understand. And as Robert Hall said, we're always having these conversations, Robert Hall, pardon me, Tony. We have these conversations about what's going on in our different markets, what's changing, what's growing, what's developing. But first and foremost, what we look for, jobs, 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 and jobs. It's always very important that your tenants have a steady income to pay your mortgage, right? Secondly, landlord friendly. Anybody who lives in California knows that choosing a state where you can actually have active control over your investment is a wonderful thing. Low cost of living, that always helps with keeping people's quality of life high and helps them have a nicer home and have a nicer quality of life. Here's a big one, cap rate, high rent versus purchase price, right? So we like to pick markets that have a very accessible purchase price, but have a nice higher rent. So you're going to be getting some solid cash flow on those properties, as well as appreciation. Low vacancy, that ties back to the jobs, jobs, jobs. We're looking for markets where people are going to have great careers and are going to be great tenants. Economic diversity as well. We pick states that have job markets that are diverse enough that aren't going to be affected if there's an issue. Say if you were invested in a smaller town which had one manufacturing plant, guess what? That plant goes out of business. Your ATM machine of an income property is no longer producing cash. We look for strong education and, of course, our reliable property management team, rounding off what it is we do for out-of-state investing. We always choose real estate markets based on the latest research and data. Now, we also provide market data research packets, which you can reach out to me. I will gladly provide them for you. They're also on our website on every single property profile page or through the Learn tab. Just look up market data packet and it will show you in all of the markets we operate in. All right, here's some basics right here about communicating income property in general. We're Marshall Reddick property rating classes. We've got luxury, A class, B class, C class, and D class. I'm going to peel through this real quick. We rate this by percentage of average cost per unit in the market. So say in, random town in Texas, an average home sale is 100% of $100,000. So the average home sells for $100,000. From 100 to 130%, we're looking at an A class. So from $100,000 to $130,000, that's A class property. From $100,000 to $80,000, that's B class. From $80,000 to $50,000, that's C class. That roughly translates to higher class property, more appreciation, less cash flow, lower class property, more cash flow, less appreciation. For out-of-state investments, we always advise hovering around that nice average median mark of a low A to a high B, just because you're going to reach the most tenants. There's a reason why that's the median line, because that's the median income, and that's what the majority of the folks can afford. Continuing on. What that also translates to is property classes have higher maintenance and vacancy the lower the class it is. You can find the full Marshall Reddick property rating ebook on our website, www.marshallreddick.com/ebook. And again, you can reach out to me if you have any questions, and I can send you that link directly. You can also schedule a consultation here. Again, my name is Tom Ahola. I'm a real estate advisor here at Marshall Reddick, and all of my direct contact information is below. That's all you got to hear from me. Feel free to take it away, Tony.
Excellent. Thank you so much, Thomas. I'm going to leave this up here for a couple seconds, and you know, anytime you need to reach out to Marshall Reddick, if you can find them online, great. If you can't for some reason, they're very well known online. It's very easy to look up their information. You can always reach out to Robert Hall. We've got all their contact information as well. Thomas, actually, before you go, I think that there's a question already in the box. Oh, that might be a question for me, actually. If I hold a property in California in joint tenancy partnership, can I 1031 into an LLC? You know what? Let's before I jump in, I'll just answer that question. I am going to hold off to answer all of the questions until the end here, but just to get this one out of the way, Francis, if you hold a property in California joint tenancy partnership, yes, you can 1031 exchange into a new property, but as far as titling it under a different name in the exchange, that is not possible. You actually have to 1031 exchange into the property, acquire it the same way that it was held, the same way that the original property was held before the exchange, and then you can do a quit claim deed to the LLC. So remember that by all definitions of a 1031 exchange, it has to be like kind in nature across the board. So you cannot change ownership, even if the partners are still the same, even if like the two original people in the partnership are the two people in the LLC, it still doesn't negate the fact that you are actually putting the property into a different entity, not as sole proprietors or as just individuals with their social security numbers. So to answer that question, you can put it into an LLC, but once the property actually closes, and then you go through the whole process of quit claiming the deed into the LLC, okay? So hopefully that answered that question. I'm gonna go ahead and commandeer the screen here. Thanks again, Thomas. I'm gonna find my name in this really long list of attendees. And I think that we are, let's see here. Thomas, if you can give me the thumbs up and let me know if this, if you can see my screen.
I think we're getting there.
Yeah, for some reason, there's a little bit of a delay.
Bingo.
There we go.
There we go.
All right. Love it when technology works, everyone, right? And especially coming out of 2020. We're doing a lot of these webinars, a lot of these actually free educational webinars, and both on the Zoom and the GoToWebinar platform. And we absolutely love doing events with Marshall Reddick Real Estate and all of their great advisors down there in Orange County. And we can't wait to get back to doing in-person seminars. That's one thing that I'm very passionate about, and the webinars have definitely allowed us to still connect, but it just isn't the same. You know, it saves people the drive, and I think we'll maybe do a hybrid from now on, right? We'll do the in-person, but then we'll also live stream it. I think that people will really enjoy that. But man, what a year 2020 was. Coming out of this year, obviously, as a tax preparer, we're right in the heat of tax season. Just yesterday, the federal government released legislation extending the filing season once again, not all the way out till July this year, but out until May 17th. So if you haven't gotten on the calendar to file taxes, or if you've just kind of been procrastinating a little bit, you do have a little bit of additional time. And that was really, really important from an accounting preparation standpoint. We were seeing a lot of work come in right before this April 15th deadline, and with the government's phone systems and on a 3-4 hour wait time, I personally didn't see how it was all going to get done by April 15th. So I am very pleased with that selection. I thought that they were going to push it out to July again, but it ended up being out until May 17th. So Make sure you get on the calendar to get filed. If you are filing an extension, I'm an extension filer every single year for my entities, for my personal, and that's for personal reasons. Obviously, I never fear an extension, but if you are filing an extension, make sure that that 4868 form, or if it's an entity form for the 7004 form, get those in the mail, get those e-filed as quickly as possible, so you don't have to worry about going past those due dates. So the power of Inc., one of my favorite topics to discuss and to talk with people about, especially coming out of this last year. What an unreal year 2020 was. A lot of economic uncertainty brewing. What does the future have in store for us? What is the new tax code going to look like? How is real estate going to be handled? Look at the stock market. Where do our investments go? Is it important to diversify? I mean, these are all concerns that people will have coming out of 2020, and rightfully so. One thing that really fuels rash decision making is fear. Fear in anything in life. And so just before we get started, I want to make sure that everyone understands that because of what's going on in the world, you're going to hear about and see people doing rash things with their money, like making really bad financial decisions because they fear a change. This time in our lives, more importantly than ever, it is incredibly important to surround yourself with advisors, with licensed professionals. These are the individuals who have studied what's going on. They are foot soldiers on the ground. We are listening to the news every single day, every morning when we wake up, every night when we go to bed, in the real estate field, in the tax field, in the financial world. This is more important than ever. Build a team around you. Build a team of advisors and heed their advice. When they tell you to do something, it's not for the good of their company. It is for the good of their client. And we want to see people succeed, because as you succeed, we succeed, right? That's the whole nature of real estate and financial planning and tax planning. So yeah, put a plan in place and surround yourself with some really good advisors. I cannot stress that enough. Just to show you who I am, since we're not on full-blown camera tonight, my name's Tony Watson, like I said, working for Robert Hall & Associates. We are a full-service tax consulting firm, been based out of the Glendale, Southern California area since 1971. We are, in fact, celebrating our 50-year anniversary this year. My role here at Robert Hall is not only tax preparation, but also I am the keynote speaker, public speaker. I also practice what I preach, so I'm very, very engulfed in tax season right now, and we've got a lot of returns being processed on a day-to-day basis. And then every once in a while, between appointments, I'll hop on the webinars and teach people about some really cool things pertaining to power of incorporating and real estate investing and the tax side of all of that side. And so I have a really, really unique job. Very, very honored, very privileged to be able to bring this information to you tonight, and also to be teaming up with a great company like Marshall Reddick Real Estate. Just in my own personal clientele, out of my 1,200 tax returns that I prepare roughly on a year-to-year basis, I personally deal with clients that manage and sell and flip and other business dealings of north of about $150 million. Our firm, I can't really give you a value on that. We've got 16 senior preparers. So what I'm trying to get at is we see a lot. There probably isn't a scenario that we have not dealt with. I mean, sure, there are things that come across our desks like special other state credits, state credits in Massachusetts and in Delaware and things like that we have to research from time to time. But for the most part, we've seen a lot. So if you feel like each year you go in to file your taxes and you're not really getting the advice that you're looking for from a tax standpoint, from a real estate investing standpoint, from a business standpoint, have us take a second look at your filings. Send us your tax returns. We offer free consultations, and we will take a full review, a second opinion of your return for free, and let you know essentially how you've done in the past years, tax preparation wise. Like I said, I also practice what I preach. I'm a tax preparer, but last year during the pandemic, I think we hit over 140 webinars in a 365-day period. So we were very, very busy bringing as much up-to-date information to the general public as we possibly could bring without boring people to death, so to speak. We do, like I said, we do offer free consultations. I will remind you about this at the tail end, but I do want to get onto the bread and butter. Is incorporating even right for you? Well, that is a great question, because incorporating, I want to be real transparent about this. It is not right for everyone. Just because your neighbor, your coworker, your family member, your friend, just because they incorporated as an LLC or an S Corp or a C Corp, doesn't necessarily mean that you should jump online and start an entity on LegalZoom. First and foremost, you need to understand a couple of things about incorporating. One, when you incorporate, normally you'll have an additional tax filing, which means additional preparation fees with your tax advisor. Just once again, being real transparent about this. If you incorporate, aside from the tax preparation fee, you also are tying yourself into a financial agreement with the state of California. Whether you are an LLC, an S Corp, or a C Corp, making money, losing money, breaking even, you get hit with what I call a parking ticket for parking your business here in the state of California. That parking ticket is a minimum fee of $800 annually. So right out the gate, you owe $800. And then on top of that, if you're not a self-prepared taxpayer, you got to pay an additional fee to file the return. So at the end of the day, before you incorporate, one, yeah, sure, you're going to get great asset protection by having an entity structure. But two, we have to make sure from a tax standpoint, from a financial standpoint, that the entity is going to save you more than it costs you. And if it's not going to save you more than it costs you, what kind of limited liability protection are you receiving? And is it worth all of the additional fees to have that limited liability protection? So once again, incorporating is not right for everyone. This is a very unique calculation, very unique consultation that you need to have one-on-one with your tax advisor about whether or not your portfolio, your personal situation warrants the need for an incorporated entity. It's very simple to start a corporate entity. For us, we do it all the time. We start probably close to 500-600 entities every single year just here at our firm. And we file close to, I think, 6,000 plus entities on a year-to-year basis. So it's a very straightforward process for us as tax advisors. If you try to navigate the rough waters of the legal code and try to incorporate yourself, once again, LegalZoom is a great overall online service that you can utilize to incorporate. However, if you don't know exactly what needs to be filed with your corporation, you could end up missing a specific type of filing. For instance, if you wanted to start an S corporation and you mistakenly started a C corporation, an 1120 form, you'd actually have to file an additional form to make an election with the IRS to be taxed as the S corporation. So if you miss that S election and you go to file your tax return the following year electronically, your return will be rejected if you try to file as an S corporation, because when in fact you never actually made the election to change the entity. And once again, I don't want to confuse you about all of this, but just understand that there is very much a reason why attorneys do a lot of incorporating or offer incorporating services, why accounting firms offer incorporating services. We want to make sure that it's done right the first time to avoid any additional filing fees or amendments on the back end. Now, out of all of the entities that you have to choose from, let's say that you check off all the boxes. You say, yes, I want asset protection. Yes, I want the tax savings. Yes, I want that additional filing fee. Who would ever say that? But at the end of the day, what are your choices? Do I want an LLC? Do I want an S Corp? Do I want a C corporation? Well, that is not the $1 million question, but that is probably the most important part of the conversation to have with your tax advisor. Just because, once again, your neighbor has an LLC doesn't necessarily mean that your entity should be an LLC. And so we have to break it down based on the different types of revenue streams, as well as assets that you are trying to protect and reduce tax liability against. I can tell you right now that the LLC, out of all three entities, the LLC is going to be the most common entity that people use. And LLC stands for Limited Liability Company, not Limited Liability Corporation. We're going to get into more detail about LLCs in a second, but I did want to make sure that everyone knew that when you start an entity, sometimes people will mistakenly think they're an incorporated entity, when in fact an LLC is not a corporation at all. An LLC is a company. And so from a legal perspective, when you file as an LLC, you're filing mainly and actually solely 100% for limited liability protection. Like I said, I'm going to go into more detail about and break down the LLC individually and then the S Corp individually and talk about the ins and outs of that in a couple slides here. But it's very important for you to choose the right type of entity to start with. Converting entities and changing entities is not a problem. However, you want to avoid having to change anything after you've already spent the time and going through the process of actually setting up the full-blown entity quitclaiming deed of title into the entity structure, setting up the bank account. Once you do all of that, you don't want to have to go back and reverse any of that. It just is very time consuming and very frustrating from a taxpayer standpoint. Above and beyond all of that, even furthermore in the conversation, you need to understand the different tax implications of each type of entity. And yes, the LLC, the S Corp, and the C Corp, even though they're all technically incorporated businesses, LLC is a company, S Corp and C Corp are corporations, but they all file articles with the state of California or whatever state you're incorporating in. Yes, they all three have a different level or different type of tax implication. So we're going to dive more into that as well as we progress through these slides. Before I jump into the detailed breakdown, though, I want to squash some very common misconceptions and misunderstandings about incorporating. Just because you have a corporation does not mean that you don't need to have insurance. Just because you have a good insurance policy does not mean that you have the same level of asset protection as having an entity structure. So I want to separate these two in the brief 5-minute conversation about this slide and explain to you why both may be very important things for you individually to have. First and foremost, insurance is absolutely the most important thing for us to have. We have health insurance in case we get sick. We have car insurance in case we get in a car wreck. We have homeowners insurance in case something happens with our homes. You get the point, right? We have insurance. It's there and in place to pay out settlements in case an unforeseen event happens. We just don't know that our house is going to burn down. We don't know that our car is going to get wrecked. We don't know that we're going to get sick. So we have insurance to fix things. Insurance has a value. It has a dollar value payout. Whereas an entity does not have a dollar value payout. An entity actually and solely separates business and personal assets from each other. So why would you want to have both? Well, insurance is there in case you are ever hurt, injured, sued for liability purposes. And so you want the insurance to kick in and cover any settlement payouts rather than you having to dip into your savings. So we get why we have insurance. But what is the benefit of the entity at that point? Well, right now, if you don't have an entity, if you don't have an LLC or an S Corp or a C Corporation, more likely than not, all of the assets that you own are attached to your personal social security number. That's one thing that we all have in common. All of the attendees in tonight's webinar, we all have in common an identification number. And that is what people pursue in a court of law. They don't necessarily sue your property, do they? They sue the identification number that is attached to the property. And so naturally, if I go about my investing life, buying everything I can under my social security number, and let's say that somebody sues me individually, they're not suing Tony Watson, they're suing the identification number of Tony Watson. I mean, hypothetically speaking, that's what they're going after. And so that's how you have to think. You have to think that if I am truly fearful of being pursued in court, my social security number should only really own a couple assets. In fact, it should own very few assets because the more separation you put between yourself and your businesses and your properties, the better protected you are. You could have all of the insurance in the world, but at the end of the day, if your insurance policy, that fine writing that says if X, Y, and Z occur, we don't pay out the settlement, well, naturally, they're going to come after you individually and everything that is attached to your primary social security number. So I'm not saying that for every property you purchase, you need an LLC. I'm not saying that for every business venture you start, you need an S corporation. What I'm saying is that there comes a point where you have to look at your asset, you have to look at your business and figure out if it is profitable enough to warrant having an incorporated entity. So asset separation equals asset protection and vice versa. An entity structure is just separating your business assets from everything that your social security number owns individually. And so you see that a lot with investors. You see property owners buying rental investments and transferring those properties into LLCs, quitclaiming deeds. And what they're doing that for is not essentially a tax benefit. That's more of a legal or asset protection benefit that they are obtaining. And so once again, we're going to dive more into detail about the LLC and the S Corp in a second here. But I wanted to make sure that everybody understands that these two things here on this screen, insurance and entity protection, they provide two completely separate levels of protection and benefit. I don't know how many of you in today's webinar who have anyone in today's webinar who's actually been through a lawsuit before. I've seen it with my clients. Knock on wood, I have yet to be sued individually on any of my properties. I try to be very attentive to my tenants and my assets that I own. So heaven, thank goodness I haven't been through one, but I have seen my business partners, I have seen clients go through hell with court cases, and thank goodness they had the right insurance policies in place to help them out. And it hasn't always been rainbows and sunshine. Obviously, there are always those unique situations where there is a little bit that gets paid at the end of the day, but the insurance takes the bulk of the hit. And so insurance is incredibly important. And for the most part, insurance will be a dollar for dollar write-off for all of your business ventures. Earthquake insurance, liability insurance, malpractice insurance, health insurance, car insurance. In most cases, car insurance might be a little bit different than the others, because if your car is used for personal and business use, there has to be some separation of business and personal. But you get what I'm trying to point out here is insurance is going to be a great write-off for your business, and it happens to be probably one of the number one most important things for us to have as business investors and real estate investors. The entity structure should really only come per the advice of a licensed advisor, either an attorney or a tax professional. And if an attorney puts you into an LLC or a C Corp or an S Corporation, always understand that attorneys will advise you on a legal level. They are not tax professionals, just like I am not a legal professional. I will not give you legal advice ever. I'll say you got to talk to an attorney about that, because that is just not my world. That's not my day-to-day reality. And an attorney will probably say the same thing about taxes. They'll say, well, we know that this is the best entity to protect your assets, legally speaking. And 9 out of 10 times I'd say, well, I agree with the attorney. I want greater asset protection. But if there is a way for us to, be able to receive the cake and get to eat it too, my boss always likes saying, that phrase, where we want our cake and we want to be able to eat it too, we might be able to take the choice of the attorney, or that the attorney sets up for you, an LLC, and then simply make an election with the IRS to be taxed as the type of entity that we want you to be under for some sort of tax benefit. So that's really, really unique, and we're going to go into more detail about that as well. So I think we've discussed most of the differences between those two insurance and entities, and then I'll also mention about the trusts in a couple slides here, and why a trust may actually be a really important level of protection for you as well. So let's talk about LLCs real quick. Like I mentioned earlier, LLC does not stand for Limited Liability Corporation. It stands for Limited Liability Company. LLCs do not file articles of incorporation. This is a general misconception with a lot of business owners. When I have the in-person seminars, I'll always ask the audience, what do you think LLC stands for? And people will yell out, Limited Liability Corporation, Limited Liability Company. Some people don't know, and they don't participate. They don't really care. Right, so you get these conflicting answers, and at the base level of just incorporating yourself as an LLC, yes, it files articles, but not articles of incorporation. It files articles of organization. So it organizes the information with the state of California, and it is not a business that is owned by shares. That's probably the most important thing, and I will come full circle as to why this is incredibly important for real estate investors in a couple minutes here. The LLC is the most commonly used entity for rental investments, whether it be commercial or residential or land, a short-term, long-term. If there is a large depreciable asset in play in whatever business venture you are operating, LLC tends to be the most common structure for asset protection. And this is something that an attorney will push more likely than any other entity because LLC does exactly what its name entails, right? It limits liability on large assets. Now, the reason why you wouldn't want to look for another type of entity for property ownership is because LLCs are incredibly unique when it comes to not only liability protection, but also tax benefit. An LLC provides you absolutely zero income tax benefit. In fact, LLCs in some cases can have higher tax rates on the state side than other types of entities. I'll give you an example. let's say that I put together a syndication with a couple of my investor clients, and we go out and we buy a shopping mall for $10 million, right? And our rent per year is a couple million dollars per year, or whatever that may be. And the LLC files its first tax return. The LLC doesn't actually pay tax at the business level on the federal side. LLCs are known as pass-through entities. So if you can imagine a funnel, right? You throw all of the rental income into the funnel, you throw the expenses into the funnel, you throw the depreciation on the building into the funnel, and then you kind of shake the funnel, and at the very bottom of it, it just squeezes out the net profit. And that net profit is taxed to all of the individual investors or partners of the LLC. So LLCs and other types of entities like an S corporation, you have to imagine that funnel example, and I'll come back to that when we talk about the S corporation. So you think that's all good, right? I mean, this money kind of passes through to me individually. I pay the income tax personally on it. Well, let's go back to the LLC for a second, because I said that there is no income tax for an LLC on the federal side, but what about the state side? The state of California has something called a gross receipts tax for LLCs. So that means that if I make, let's say, $2 million in rent, I spend $1.5 million in expenses, and I've got net profit of $500,000 now, and it splits out into the 5, 10, 15, 20 investors, and we all split that evenly. The filing fee alone in the state of California is not based on $500,000 of profit. The filing fee in the state of California on the gross receipts would be an assessment on $2-3 million of rental income. And so that could be upwards of, I think, $11,995 or 12 grand essentially in filing fees if you file as a limited liability company with high gross income, with high gross receipts. So once again, the LLC doesn't provide any tax benefit. It has one of the highest the LLC has one of the highest filing fees, especially here in the state of California, because it is based on the gross receipts for the business. And when I mean that it doesn't save you any income tax, I mean that whatever the bottom line profit is, that is what you end up paying tax on. And once again, I'll define the differences between the entities in a couple seconds here, but the LLC truly is only for limiting liability. When you acquire property and you quit claim deed, one of the questions early, right when I logged in, was about the quit claiming deeds or 1031 exchanging. When you put property into an LLC, you are not trading the property for any shares of a business, are you? Because the LLC doesn't have shares. It has percent ownership. So one thing that's very unique about an LLC, and once again, it'll tie into the conversation about the S Corp in a second here, the LLC, if you put a property in there, you are essentially trading the property for percent ownership of the LLC. So if I have a $500,000 property and I quit claim the deed to my LLC, let's say I'm the only owner, now I have essentially capitalized the LLC with a $500,000 asset. That's called a property contribution or a property infusion into the LLC. There's no income tax implication for any of that. Depending on the ownership changing, if I'm a single owner of the property and I transfer it into a partnership with my son or with a friend, there may be a reassessment of property tax upon transfer, but as far as income tax is concerned, there should be absolutely no income tax liability on that transfer. And I'm being very vague. There might be a very unique scenario where there is income tax on that, but for the most part, it's just putting money or property into an LLC, not trading it for any shares of a corporation. So LLCs are great for protecting large depreciable assets. They are one of the most common entities used for limiting liability on those assets, and they are great for separating properties from your personal name. It is not always worth it to have a single LLC for every property that you own. And I can't really be very detailed about why that is until I see somebody's individual profile. But I don't want you to leave this webinar or go out and go online after today's webinar and start setting up LLCs for each one of your properties without understanding not only the financial implications of that, the California filing fees, the tax preparation filing fees, but also whether or not it creates any sort of added limited liability protection for you to begin with. I mean, if you have 15% down payment on a property and you finance 85% of that property, who actually owns that investment? I mean, at the end of the day, the bank does, right? The bank would disagree with that. They'd say, well, no, actually, you borrowed the money, you're on title, so on and so forth. But at the end of the day, that's actually the bank's asset still. And so if you're renting out to a single individual, very low risk, very low liability, you have a very low down payment on the home, why would you need that great limited liability protection if you have very low risk and liability, and maybe the cash flow just isn't there yet because you have a loan position on there that really eats into a lot of your cash flow? On the other side of the spectrum, or the other end of the spectrum, let's say that you rent out to a family with small children and you have 50% equity in the property. So you already have risk and liability with your tenants because they have small children. And number two, you should be cash flowing pretty nicely on that property because you have very low debt on the property or attached to the property. So two different scenarios, right? One is a cash flowing business with a little bit more risk and liability, probably deserving of an LLC at that point. The other situation is very low risk and liability, low equity in the property. And at that point, I'd say that a custom, a finely tuned insurance policy would do the job before the limited liability company ever needs to set in. So just a brief overview of that LLC. Once again, very popular for rental investments, not always needed though. Now, for the self-employed individual, LLCs are great for limiting liability on properties and businesses, but in most cases, a self-employed real estate professional, property flipper, property manager, realtor selling property and making commission income, an individual who invests in real estate but also owns side businesses, eBay online sales businesses, networking businesses, consulting businesses, you name it. If it's self-employed income, aside from asset protection, you also are looking for something that can help you reduce the amount of self-employment tax that you're paying. And so here we intro one of my favorite entities overall, the Subchapter S Corporation. Now, the Subchapter S Corporation is a full-blown corporation. It's one of those entities where you actually end up owing shares of the business. Now, if you are set up as an LLC, and after I discuss the whole S Corporation topic, if you're thinking, man, that crazy Tony guy, he really has me thinking about whether or not I need the LLC or if I actually need a Subchapter S Corporation, do not worry. You don't have to shut down your LLC and start a whole new entity. There is a special election, a 2, 3, 4 page document that our office can put together for you that simply converts your LLC into a Subchapter S Corporation. So after we talk about all of the major benefits built into the Subchapter S Corp filing, you may want to take that next step to convert the LLC to an S Corp, but we will want to talk about that before we do that. We want to make sure that all the ducks are in a row and T's are crossed, I's are dotted, just to make sure that we are doing it for the right financial reasons. S corporations out of all entity choices are the only entities that can actually save you tax. But the general misconception is that when people tell them that an S corporation is going to save them tax, they think, oh, I'm going to pay less federal income tax and I'm going to pay less state income tax. When in fact, the S corporation doesn't save you any more than an LLC does on federal tax, and an S corporation doesn't really save you any more on the state side than an LLC does as far as tax reduction and tax savings is concerned. What an S corporation allows a business owner to do specifically, and especially self-employed individuals, is the S corporation allows them to reduce the amount of Social Security and Medicare tax that this business owner will pay. Social Security and Medicare is also known as self-employment tax. They're the same thing. It's just if you're a sole proprietor or just a straight up self-employed individual, not incorporated, whatever your profit is through your business, your self-employed business, you will pay federal, state, and Social Security and Medicare tax, except you're paying it as self-employment tax. When you are incorporated, you actually have to put yourself on a payroll, which we'll get to in a second. I'll dive into that calculation in a moment. But you actually are no longer self-employed as a corporation. You are an employee of your own corporation, and employees get paid via W-2. This is where the magic really starts to happen under an S corporation. But I want to make something, once again, very, very clear. I want to make sure that we kind of break down what we're trying to coach here, to trying to portray as far as entity selection is concerned. The S corporation, once again, will only save you Social Security and Medicare tax. It will not reduce federal and state income tax. So when you talk about rental properties versus maybe a realtor business that earns commission income, rental income does not pay self-employment tax. It only will ever pay federal and state income tax. The commission income you make on selling property as a real estate professional or a realtor, that actually pays federal, state, and self-employment tax. Well, if the S corporation only saves you self-employment tax, what income do you really want solely focused under the S corporation? You don't want any of your rental income because the S corporation isn't going to save you any tax. You're looking for the tax savings, the tax benefit under the S corp. So you'd put all of your self-employed ventures under an entity like an S corporation, and all of your rental investments under LLCs. That is a very common conversation to have about rental properties being in LLCs versus S corporations. But I'm going to dive into even more detail about why an LLC is mainly specifically beneficial for a rental property versus an S corporation, which could actually end up causing you to pay more tax on rental investments, even if you never sell the property outright. So let me wind back really quick and give you an example, because examples are always better. They paint a picture, right? And I love, a tax return paints the picture of your year to the IRS in numbers. Through webinars, it's really hard to teach people about what we do specifically on returns, and I'm not trying to do that tonight. But I want to make sure that you understand some of the major tax implications that you could see if you start to make rash decisions by quit claiming deeds to entities, adding children to title because of Prop 19 fears. I mean, there are a number of things, moving parts that we need to discuss when pertaining to title transfer of rental investments. So let me give you an example. Let's say that in 2001, you and your spouse went out and bought a $300,000 property in 2001. You owned the property for a couple years, and then you decided, hey, because the economy is really good and we start to hear a lot of these really scary stories about people being sue happy and wanting to come after us for our assets, you decide as a couple that you want to take this $300,000 property, this investment property, and you want to quit claim it into an entity. Now, if you quit claim it into an LLC, great. You've got great liability protection. That's probably the go-to entity for you, hands down. But if you misunderstood advice from a tax advisor, from a seminar, a webinar, a coach, and you accidentally or intentionally, in fact, put the property, the rental investment, into a subchapter S corporation, right away, there's no immediate tax implication. Your basis of $300,000 still stays the same, maybe plus adding on some improvements that you made to the property over the couple of years that you've owned it. And so you take this title, you transfer it into an S corporation. Well, at that point, yes, it is a property contribution to a corporation, but you are not trading that property for percent ownership like you did under an LLC. You're actually trading that $300,000 property for $300,000 in shares of a corporation. So now you don't actually own a property, do you? You own 300,000 shares, or whatever the par value is. Let's say it's $1 per share. You own $300,000 in shares of an S corporation, and now your corporation, your S corp, owns the property. So why are you talking about this, Tony? What is that? Why does this make sense? Bring it full circle. Well, let's say that you own that property in this S corporation for the next 10 years. And you come to the end of that 10-year period and you think, well, now my spouse and I, we have children who are a little bit older. We want to put them on title, start to teach them about managing the property, or even without children, we just want to take it back to our personal names because the S corporation really took off in a different direction. And now we're doing mainly property management or wholesale deals under this entity. We don't actually want a rental investment in this entity anymore. So without talking to a legal advisor, without talking to a tax advisor, you just simply think, well, I'm not going to sell the property, but I want to take it back. There's no tax implication for me because I owned it, I bought it, no ownership is changing, I'm just taking it out of the corporation. Well, 10 years into the future under this corporation, when you capitalize the business with a $300,000 property and traded it for $300,000 in shares of this corporation, 10 years later, let's say that property is now worth $1 million. So it went from 300,000 purchase price, now it's worth fair market value at the time that you are talking about distributing it back to yourself or taking it back out of the corporation. Let's say the property is worth $1 million now. So you go ahead, you go through the quit claim process, you quit claim it back to yourself, and you think, okay, well, now I own it personally. I might put it in an LLC or own it personally for a couple of years. And so no harm, no foul. Well, the government actually views that as you selling shares of your corporation for a fair market value at the date of disposition. And what is your basis in this property? Your basis is $300,000. When you sold this property or took it, not even sold it, but you took it back to your individual name, the IRS doesn't view it that way. The IRS actually views it as a corporation selling an asset. Sure, they sold it back to a shareholder, but at a $700,000 capital gain, plus depreciation recapture. So you have a lot of these very unique moving parts because you didn't sell a property outright. You sold shares out of your corporation that you own. And so you may end up having a very serious tax implication on the back end if you bring that property back to your individual name. Now, there are a couple underlying factors. If you have suspended losses through the business, if you have capital losses through the business, it might not be that much of a tax burden. But these are very important things for you to understand before you just start quit claiming deeds to different entities and adding entities or individuals to title. You are giving up some major income tax benefits by doing so. You know, and I don't want to get off topic and talk about Prop 19, but I see a lot of people adding their children to title out of fear that Prop 19 is just going to reassess the basis of the property at a much higher value if their children don't move into the property after their parents pass away. And I can tell you right now that, yes, there are ways to mitigate or minimize the overall reassessment of property taxes under Prop 19 by doing so. But what you are giving up for your children is the complete tax-free stepped-up basis benefit upon death. Meaning that the number one and number two benefits built into the Internal Revenue Code, number one is the stepped up basis benefit. Number two is the 1031 exchange, which we'll talk about as well. But the number one benefit is this inheritance stepped up basis benefit. And essentially what that means, for those of you who don't really understand the death benefit stepped up basis, is if my parents pass away with $3-4 million in real estate, and their basis is very low. Let's say they bought all of that property for 100 grand. Now it's worth 3 or 4 million bucks. If they sold it in their lifetime, they'd pay all of this capital gain tax, right? But if they leave it for me and my brother or next of kin, or even our grandchildren, the generation skipping tax, you know, there could be a complete tax-free benefit to us on the back end. Because guess what? Under the current Internal Revenue Code, the estate exemption is upwards of about 12 million bucks. That means that if my parents do not transfer title or add me to title before their death, when I inherit that property, I inherit it not with their basis of 100 grand. I inherit it with a basis at the fair market value of the property at the time of their passing, which could be 2 or 3 million bucks. A week later, I could dispose of the whole real estate portfolio for 2 or 3 million bucks, pay absolutely no capital gain tax on all $2 to $3 million of assets. I mean, and that in my mind is just probably one of the most incredible things built into the current Internal Revenue Code. And that far, in my opinion, far supersedes any Prop 19 reassessment. Now, the only trigger here is that if you have one of those amazing properties that I'm sure your kids and their grandchildren that they'll keep for generations upon generations, then yes, adding them to title and kind of forcing them into keeping that property without, you know, receiving that huge capital gain, but definitely inheriting a lower property tax basis, that would probably be more the advice of a financial or wealth manager. Not so much income tax professionals, because we want to map out all angles. We want to map out the capital gain tax benefit and death. We want to map out the Prop 19 reassessment. We want to take a look at all of the moving factors. We want to take a look at the chessboard and make sure that whatever move we're making, that 10, 15, 20 moves down the line, we're not, you know, pardon my French, but screwing ourselves by doing or making these rash decisions because we have fear of what the changes under Prop 19 or the capital gain tax exclusions or stepped up basis benefit will be in future years. This is everything that a tax advisor, a licensed income tax advisor, should be mapping out for you. You know, these are really, really important and very unique questions, especially if you've been fearing Prop 19, if you've been fearing end of life planning, if you've been fearing your kids liquidating your assets after you're gone and spending it all on sports cars and Bitcoin and baseball cards, right? Whatever the, you know, kids are buying nowadays. So if those are fears of yours, you know, you need to talk with licensed advisors. You need to talk with a tax advisor. You need to talk with an estate planner, trust planner, a wealth manager to make sure that all of your ducks are in a row. And at the end of the day, if you are satisfied with the results of all of that, that is a power position, in my opinion. Because the more you can plan ahead and the more tax you can save, guess what? The equivalent to tax savings, in my opinion, is retaining wealth. It's wealth retention. If you can map out a plan that helps you save tens of thousands of dollars, if not millions of dollars in income tax, you were able to retain all of the hard-earned wealth that you've built for yourself over the course of your life and your career. Okay, so be aware of that. S corporations, very, very unique entities for self-employed individuals, but for property owners, for long-term rental investors, not such a great entity to utilize. If you are a property flipper, different story. If you are buying and rehabbing properties and selling them within 365 days, meaning that they are not long-term asset holds, short-term flippers will receive major, major benefits under the 1120 S corporation, especially if they are flipping 3 or more properties within a 365-day period. At property dealer status, for instance, the government says that if you flip over 3 properties within a 365-day period, you're not just a small-time investor at that point, you are actually deemed a property dealer. And why this is important for us to all know, the property dealer status, is that if you are deemed a property dealer under audit, the federal government will not only hit you with short-term federal and state capital gain tax, they will also hit you with Social Security and Medicare tax, self-employment tax, on all of your short-term property dealings. So you want to get ahead of that. If you are that individual who wants to enter into the property flipping sector, S corporations will reduce or help reduce self-employment tax by a large sum. And how does this all work? I was told you I was going to break this down for you and show you kind of the power behind the S corporation. Remember that as an LLC, which is the first column, or a sole proprietor, we talked about how the LLC provides no tax benefit whatsoever, right? So let's just assume for this example, let's say that you're a property manager. You have rental properties that you own, you've got some rehabs you're working on, but your main income is managing property, and that is straight up self-employed income. And let's assume that your business, after all is said and done, after expenses that you've taken into account, you've got 100 grand in profit. Well, clearly under the sole proprietor LLC column, based on these estimated tax rates, you're paying the exact tax that you should be paying as a sole proprietor in LLC, because it saves you absolutely no income tax to file as a sole proprietorship, which is just you individually, or under an LLC, because the LLC only provides great limited liability protection, but absolutely zero tax benefit. When you are self-employed and you are hitting specific numbers like 100 grand in profit, it is per the advice of a licensed tax advisor for us to at least make the calculation of what an 1120 S corporation may save you. And like I mentioned earlier, you are no longer self-employed as an S corporation. You are actually a salaried employee under your corporation. You just happen to be the majority shareholder, and you're the only employee in most cases. And employees under an S corporation have to be paid based on a very specific ruling under the IRC called the reasonable salary requirement payout. And the reasonable salary for self-employed real estate professionals can be as low and no lower. And this really also comes down to case study, and case study has proven that 40% of your company's net profit is a reasonable salary, no lower, and you don't have to pay yourself any more. If you overpay yourself, no harm, no foul. If you underpay yourself, there may be a catch-up bonus towards the end of the year to bring you up to 40%. But once again, this is all a calculation that needs to be made by your licensed tax advisor. So as you can see under the S corporation, nothing changes with federal tax, because it doesn't matter how you split 100 grand into $40,000 W-2, 60 grand profit, 50 grand W-2, 50 grand profit. Doesn't matter how you split it, the overall property or profit still adds up to 100 grand. So your federal and your state income tax stay the exact same. But look what happens to your self-employment tax. It drops significantly, right? And that's because as a sole proprietor or a single member LLC or multi-member LLC, you pay self-employment tax on the full profit, which is 100 grand. So ease of calculation, just rough estimates, and these I'm being very vague with these calculations. There are a couple other factors that we have to take into account, but I'm trying to make a point here that 15.3% of 100 grand, that's upwards of 15,000 bucks. Whereas under a corporation, you paid yourself a salary, right? You paid yourself a W-2. The W-2 is subject to federal tax, state income tax, Social Security tax, Medicare tax, unemployment insurance, state disability. So you have this $40,000 W-2 that is subject to all of those taxes, and then your corporation gets to write you off. The corporation actually gets to deduct everything it paid you as a salaried employee. So 100 grand minus 40 grand in W-2 leaves the company with a $60,000 leftover profit. In this example, just by filing as a self-employed S corporation, you are effectively able to reduce your self-employment tax by upwards of about 9 grand. right out the gate, just on 100 grand of profit following the reasonable salary requirement. Now, not all industries can pay themselves 40%. Real estate tends to be around 40% on average. If you're a medical professional, a brain surgeon, one of these concierge doctors that's really, popular in the LA area these days, you may have to end up paying yourself a much larger salary because in that specific industry, they tend to make more earned income than in other, real estate related type industries. And let's face it, in the first, second, and third quarter, some real estate professionals, they might not know when their next check is coming. 2020 ended pretty well, but in 2021, I have a lot of my real estate professional clients really strapping down, putting money aside because they just don't know the certainty of the future. We don't know what the future has in store for us. We don't know what the tax code is going to be. We don't know how the economy is going to be impacted by the trickle-off effect of the pandemic. There are a lot of overall, outside factors that we need to take into account. So doing this, playing this game allows you once again to save tax, which in my mind is the same as wealth retention. We want to retain as much of our hard-earned income as possible by planning ahead and implementing strategies that are built in to the current Internal Revenue Code and allow us to keep more of our hard-earned money. So even at $50,000, you're yielding a profit of roughly about $4,500. So the goal here is to calculate, as a tax advisor, to calculate, number one, whether or not it's even worth going through all this hassle to start a corporation. Do you have assets to protect? Yes, check that box off. Do you have enough revenue to pay yourself a salary to play this reasonable salary game? Check that box off. Yes. And so if you meet all of the requirements, a couple other Q&A questions that we'll go over, but at the most part, if you match most of those check boxes, if you check all of those off, then why would you ever want to leave this kind of money on the table? Sure, there's extra paperwork. Sure, we've got to run payroll. Sure, there's additional filing fees. But if this entity saves you double in tax what it's costing you on a year-to-year basis, financially speaking, it is a great opportunity for you to start retaining more of your wealth on a year-to-year basis. So essentially, from a bird's eye view, 100 grand in net revenue, you got to pay yourself a 40,000 or a 40% reasonable salary. You get to write yourself off. You got 60K in leftover profit. You avoid, not evade, you properly avoid self-employment tax on 60 grand. You pay Social Security and Medicare tax on the $40,000 salary, which is called payroll tax, which we all know about, right? But you are only subject to payroll tax on the 40 grand, not the 60 grand. And so in this scenario, on 100 grand in net revenue, you're reducing your overall Social Security and Medicare tax by upwards of 9 grand plus. And that's just one of the overall benefits of operating your self-employed business as an S corporation versus a sole proprietorship / LLC. Now, as you move into the corporate structure, you're wondering, oh, well, do my deductions change? Well, actually, no, your deductions stay very similar to when you were a sole proprietor before you incorporated. It's just through a corporation, you tend to have a lower risk for audit. That's not really proven. It's just statistically speaking, after 50 years of being in business, as Robert Hall and Associates has, we've gathered some stats on how many audits we see for corporations versus sole proprietorships. And once again, there's no website you're going to go to that tells you that by incorporating, you're going to have a low risk for audit. It's just simple numbers. I think that in order to audit a corporation at the IRS, you have to be a licensed auditor in the corporate field. And so there's less of those individuals than individual sole proprietor auditors. So I truly believe it's a simple case of manpower. But I've heard other opinions. It doesn't matter what the opinions are. At the end of the day, we look at stats, and the stats prove that entities just have a lower overall risk for audit. So when you incorporate, your deductions pretty much stay the same, because if you're self-employed or a real estate investor, or if you're incorporated as an LLC or an S corporation, the deductions are going to be the same. On a rental property, you've got your property taxes, you've got your mortgage interest, you've got your homeowner's insurance, you've got your HOA dues if you have those, you've got your repairs, your travel back and forth from the property, supplies, equipment, appliance repairs, solar property, depreciation. I mean, you've got a number of opportunities here, deductible opportunities to offset your rental income completely. One of the main deductions for individuals who have vacancies is marketing and advertising. That's going to be one of the top 5 business deductions across the board, whether it's a rental property, a realtor selling property for commission income, or maybe even an online eBay, Amazon business, right? Marketing and advertising is very important. It's mainly in real estate to fill a vacancy, get that tenant in that property, because remember that even though you own an asset, which is your property. What truly is, take a step back and have a coming to a deity moment here, where what do you truly think is the asset in this situation? Is it the property or is it your tenant? Well, sure, by definition, if you look up the definition of an asset, it's something that you can touch, it's something that has value, it's something that is tangible. And for that, and in that case, it's the property, right? That is truly an asset. But what is a property without its tenant? It is a liability, it's a depreciating asset. If no one lives in there and upkeeps it, takes care of it, it falls apart over time. And so it becomes more of a risk and liability for you to not have a renter in there because, once again, if you have a mortgage especially, your mortgage isn't getting paid, or at least you're dipping into your own savings to cover the expenses on a monthly basis. So the true asset, what I was taught very early in my investing career, is that the true asset in a rental property investment is truly a tenant. It's somebody who is paying you money to live in your asset. So always remember that, and you want to fill those vacancies as quickly as possible. Marshall Reddick and their management team elsewhere in the US, I can't even stress this enough, that when you own property outside of California, to have boots on the ground in other parts where your properties are. If you're here in California, like I am, I have properties in Texas, I live here in California, and especially during tax season, I barely have time to pick up my cell phone, right? Because I'm answering the office phone, returning emails, all of that stuff. Our days are busy. And so if you have investments elsewhere, you need good property managers. Marshall Reddick has a massive Rolodex of great professionals elsewhere in the US that absolutely you should be taking advantage of and meeting with their preferred vendors. And they're the ones that are probably going to do the marketing and advertising. But at the end of the day, that's a dollar for dollar reduction of overall rental income. Professional supplies and equipment, very low risk for audit. Let's face it, how many people do you know in today's day and age who can do what they do professionally without a computer, without a cell phone, without a microphone? I'm using a microphone right now, without a tablet, without a desk, a chair, a filing cabinet. You catch my drift. Very, very low risk for audit because the government assumes that every business owner, rental property investor, self-employed online business owner, you have these types of equipment and supply expenses. Car and truck, mileage versus actual car expenses, leasing versus purchasing, always a quandary. It varies amongst investors and business owners. I do not want to sit here and tell you that everyone will receive the same purchase benefit for going out and buying a vehicle for business use. It really all depends. As a tax advisor, I do not like using the phrase "it depends," but it truly does. In a webinar scenario where there's 60, 70, 80 plus people logging in, it really all depends on your individual tax scenario and how it will impact you in your income bracket. Let me give you a quick example. Let's say that you go out and you buy a vehicle thinking it's going to save you a lot of tax, but because of the pandemic setting in, you actually weren't able to collect all of your rent. You weren't really working too much through the business, so you collected a little bit of unemployment. So 2020 was a little bit slower of a year, but you thought, I'm home, I've got savings, I saw this really nice car at the lot down the street, I'm going to go buy it. And so you buy it, you put it under your business, you do all these great things, and you think, man, my tax advisor is going to be really, really happy for me and with this write-off. Then you go in to file your taxes, you realize that the income was less this year, and so your expenses outweighed your actual income, and you're actually showing a loss, maybe even to bring you down to a 0% bracket. Well, how much did that car save you if you're already paying no tax, right? So it's very much a great deduction overall, and it varies based on the situation, the scenario, the environment, the year itself coming out of the pandemic. And it's very, in a car purchase, before you make that investment, you absolutely want to have a conversation with your tax advisor about how to acquire title, how much it's going to potentially save you, if it's worth it to do it this year versus next year. It all comes down to the power behind the plan, okay? I cannot stress that enough. Failing to plan is ultimately planning to fail. We've always heard that phrase before. That phrase goes hand in hand with our industry, with the tax industry, more than just a couple ways. Okay, put a plan in place, implement it, and get yourself to a point where you pay your obligation in tax and not a penny more than that obligated amount. Number 4, legal and professional fees, great overall dollar for dollar write-offs. Those are going to reduce your rental income amounts, once again, dollar for dollar, really help you plug into those nice tax sheltered, tax deductible savings. And in most cases, if you are not self-employed, if you're not a rental property owner, legal and professional fees are not deductible for anyone else but you. As a W-2 wage earner or a person who has pension income or Social Security income, legal and professional fees used to be a little bit of a write-off for those individuals, and it was filed on a form called a 2106 form that could be allocated different ways. But as of 2018, under the 2018 Tax Reform Act, Really the only two, I'm being very vague with these two examples, really the only two business individuals that can write legal and professional fees and the rest of these expenses off are rental property owners and small business owners, because there is no other place on a federal return for a W-2 employee to write these expenses off anymore. That disappeared in 2018. On the state side, they'll still allow most individuals to deduct these expenses. California has not conformed to the IRS code from 2018. And this very much could change under Biden's tax administration. We don't have the final verdict, the final scripture, the final code for 2021 or 2022. We just passed the relief plan last week, and he's starting to roll out, the checks are being sent out, the stimulus checks. So there's a lot going on right now. They really haven't decided on the internal revenue code changes for 2021 yet. We do know that there are some very significant changes on the horizon. And once we have those changes, I promise you I'll be back with a finely tuned PowerPoint for you with all of those very unique, very important changes for us to really start honing in on the planning side of things. Number 5, property deductions. Last but not least, we've got mortgage interest, property taxes on the primary residence. Those are the main 2 deductions for you. Sometimes they are limited depending on how much first position debt you have on that primary residence. For instance, as of 2018, if you bought a home to live in, your primary residence, after the beginning of 2018, you are only allowed the interest deduction on up to the first $750,000 of mortgage debt. That means that if I go out and I buy a $1.2 million home, let's say in June of 2018, I'm sure it's a beautiful home. I put $200,000 down on it. So now I finance $1 million. Because I bought that property after December 15th of 2017, it's a newer property, I am only allowed the interest on that loan, deduction on that loan, up to the first $750,000 of debt. And if I have $1 million loan, that means that I lose the interest portion write-off on $250,000. So make sure, once again, that it's not the Wild West. You just don't want to start plugging numbers into a self-prepared software program and seeing that it saved you a lot of money without knowing some of these major limitations that have been put in place over the last 3, 4, 5 years. On the property tax side, we're capped at $10,000 on the state and local tax. We call it the SALT deduction. And that includes the property taxes and state income tax that you pay through your W-2 and on your primary residence, as well as a second home that is not rented out. The magic behind property deductions really happens once you convert that property into a rental investment. When you change that primary asset into a business, all limitations are removed. I mean, I'm once again being very vague, but like 99.9% of the limitations are removed on all of your expenses, because you are no longer holding it as a personal asset, are you? You are now holding it as a business. Rental properties, whether you like it or not, they're businesses. They generate revenue, they have expenses. By definition, a business is something that generates or provides a service, generates revenue, and has overhead. And so a rental property is allowed to deduct more than just the $750,000 limit on the mortgage interest. You can deduct all the interest that you want because it's a business. You can deduct all the property taxes that you want because it's a business. And then if there are HOA dues, if there are association dues, if there's insurance, if there's improvements, if there's roof shingles, I mean, you name it, an improvement on a rental investment will be deducted somewhere on that property. Now, if you do a major structural improvement, that's where the conversation needs to be had with a licensed tax advisor. If you blow out a wall on a building and you add 2,000 square feet to that building, a majority of that building improvement will have to be depreciated over the lifespan of the asset, which is 27.5 years for residential, 39 years for commercial. Under the CARES Act, however, if you do interior improvements, and I'm going to be, once again, very vague on this because there's a whole list out there that you can download on the IRS website and list on other really knowledgeable online resources that will talk about what is considered to be QIP property, QIP. QIP stands for Qualified Improvement Property. And the way that I always remember this is essentially anything that is interior improvement. That normally is qualified improvement property. Anything that is drywall, insulation, 2x4s, and you build out additional square footage, foundation, things like that, that is structural. And so that is limited to the overall write-off that you're allowed to take. When you add ADUs, accessory dwelling units, into the mix, some things can be accelerated 100%, others need to be depreciated over the lifespan of the asset. Very, very unique conversations. And just because your neighbor got a full deduction for an improvement in their backyard doesn't necessarily mean that you also meet those same requirements. Just because somebody is taking major losses through real estate investments does not necessarily mean that you and your spouse or you as a single individual are allowed the same benefit. Everyone's tax return is different. Everyone's tax return is unique. That is probably the best advice that a tax professional can give a taxpayer, is that you are unique. Pat yourself on the back, give yourself an award for being unique, and that also puts you in a very powerful position now, because you have the ability to go to a tax advisor and custom tune the planning specifically for your financial world. And that is just, I mean, in my opinion, and I think I share that opinion with a lot of people, especially the individuals who are investors, who have built a lot of wealth. If they look back on their life and they realize, wow, I probably wouldn't be where I'm at with my real estate portfolio if I didn't plan, if I didn't have a good tax advisor, if I didn't have good legal advisors, if I didn't have teams like Marshall Reddick Real Estate. You know, these are all the unique partners that you want to join up with and make sure that you're bulletproofing your overall real estate investment portfolios and your whole financial world in general, but specifically custom tuned to your world, not someone else's, and not based on the advice that other people give you. Okay, only licensed advisors. Now, coming out of the pandemic, home offices, those are it's a really commonly asked question nowadays. Hey, are in-home offices still high risk for audit? Did anything change with that? Am I allowed to take more square footage out of my house because both me and my spouse are working from home? Well, make no mistake, in-home offices will continue to be high-risk audit items for a number of reasons, but one reason in particular. People tend to overestimate the workspace in their home. I see it a lot because I'm a tax advisor. I've heard about it a lot in our tax conferences that we go and educate ourselves under. And I have to tell you that the one thing that gets a self-employed individual audited fastest on this particular write-off is not the deduction itself. It's not your mortgage interest. It's not your property taxes. It's not your rent. It's not your utilities. It's not your improvements, your gardener, your house cleaner. It's none of that. It's the unreasonable allocation of office space to total square footage of your home. That is what flags people for audit. Because whether it's true or not, and you can argue until you're blue in the face, the government is going to find 50% of your home to be an unreasonable percentage that you're using for office space. I'm sure that some of you are laughing a little bit. I always chuckle a little bit because I do actually, surprisingly enough, have artist clients who live in these downtown lofts, and they convert their whole living space, pretty much like 90% of their living space, into their work studio. And that's fine, and I'm willing to roll the dice on that very specific situation, but I do have to be really transparent with the client that, hey, if you are pulled for audit, this is one of the 3 deductions that the IRS can still come physically to your house to verify. They can come in with tape measures, they can come in with schematics, blueprints, all of that stuff. I doubt they will, but it gets pretty scary when you think about that, right? Because what else will they see? What else will they question? And once again, I'm not telling you this to make you fearful of taking this write-off. At the end of the day, there's a whole page in the Internal Revenue Code that states in-home offices are ordinary, necessary, and legitimate write-offs. And so you should absolutely be maximizing these deductions to their fullest. So do not be afraid to take the write-off, but above and beyond anything, know that the in-home office write-off is ordinary. It is necessary. So ordinary in business, it's necessary in business, and it is absolutely 1000% a legitimate write-off. But above and beyond all 3 of those checked off requirements the IRS looks for, make sure that you are being reasonable with your allocation. And that allocation, that reasonable estimation or guesstimation, can also be a conversation with your tax advisor. I have no problems telling my clients straight up, being fully transparent about it, whether or not the allocation they are trying to use will increase their risk for audit or decrease, or if we can be a little bit more aggressive based on taking the nearest bathroom to the office space as part of the square footage. I had a lot of sound recording studio artists turning their garages into sound recording studios during the pandemic. So you're talking about a very unique time in everyone's lives. Yes, I truly believe that there will be less audits on in-home offices, but the statistic will stay the same. It's not going to change moving forward. Maybe the in-home office write-off for 2020 will have a lower risk for audit, but make no mistake, when 2021 and 2022 roll around, that is still going to pop up on the IRS's radar if the allocation seems suspicious or overzealous. I like that word. So overzealous. There are other ways to maximize tax benefits rather than really trying to angle your in-home office as a major tax shelter on your individual returns. Now, back in 2018, a lot changed. We talked about the mortgage interest limitation, some of the property tax limitations on the primary residence side of things. One major breakthrough, one major benefit for business owners, rental property investors, self-employed individuals, basically anybody who had non-passive and in some cases passive income. Something was introduced in 2018 called the Qualified Business Income Deduction, also known as QBI. QBI was a very unique thing introduced under the Trump administration, which their tax bill was incredibly pro-business, incredibly pro-real estate, pro-business. It was not pro-employee at all. The Trump administration had taken away a lot of deductions for teachers, for firefighters, police officers. And what they had thought, and I doubt that Trump thought this, Trump just signed off on the thing, but whoever wrote the tax bill probably had a firm belief in the fact that teachers and firefighters, they did keep and police officers, they kept our community safe, right? And they put out fires and saved lives, and teachers were educating the future of America. But the government, I feel, was not short-sighted, but maybe a little bit short-sighted. I'm not going to say too much short-sightedness because I do actually see kind of both sides of the fence here. The IRS, whoever wrote this part of the code, realized that teachers and firefighters and police officers, they were saving lives and educating lives, but they were not creating jobs in the US economy. Now, teachers, yeah, they educate people and they send them off into the real world to find a job. But in most cases, you can't really correlate a job created through a police officer's service or through a firefighter's service. Once again, we're talking about a person like Bob Hall, right? Bob Hall is the business owner. He created 55 jobs here in the California economy and in the US economy, 55 people who receive W-2s, who pay taxes on all of that, who buy homes based on that income. So you understand what I'm trying to say. And so when they rolled out this tax bill in 2018, it was really meant to benefit the business owner. Yes, it benefited large business, but it also very much benefited small business owners as well. And there were a couple things kind of hidden into that IRC code that passed the reform bill in 2018 that if you didn't notice anything on your individual returns, it was either one, because your accountant never explained it to you, which, who knows if you actually want that explanation. I sure would if it was my money. But I really like to take the time to let clients know, hey, this is the QBI deduction that you received. And if your accountant didn't explain that to you, maybe you actually made too much to qualify for this. Because the QBI deduction here, first off, we need to ask ourselves a question. Are we married, filing joint? If yes, go to the left. If no, go to the right. Next question is my taxable income below $326,600, or is my taxable income as a single individual below the $163,000 threshold? If yes or no, then you go to the next one, right? So you go to, let's click it, there we go. If you say yes, you go to the bottom one. Is your taxable income over $426,600? If you said no, then the deduction for QBI is 20%. Now, this doesn't make any sense to you right now, but I'll kind of come full circle. I do want to get through the rest of this clicking here really quick. So if you've answered these questions, and let's say you fall between $426,600 or below, right? You're in the threshold to qualify for this thing called a QBI deduction. And essentially, if your income matches these thresholds, this means that the first 20%, not 2%, but the first 20% of your property rental cash flow, of your self-employed business profit, of your K1 partnership income, of your K1 S corporation income, the first 20% of whatever that number is pays zero income tax. Let me give you a very specific example. Let's say that me and my wife are real estate professionals. She sells property, commission income is about 200 grand, profit after expenses. I come in, I make commission income of $100,000 after expenses. Collectively, we're at $300,000, and let's call that our taxable income. So that's after our home deductions, after our charity, after our travel, all of the business write-offs, 401ks, IRAs, all of that stuff. So we've got $300,000 in net revenue. Well, clearly we're under the $326,600 threshold. So we will qualify for the full QBI benefit, which on $300,000 of taxable income, 20% of $300,000 is $60,000. And essentially in this year, if that is the case, if those numbers mapped out, that means that $60,000 of our self-employed business profit pays zero federal income tax. That is a massive, massive credit for small business owners. And once again, there are a couple other qualifying factors, but this is the main gist of the QBI deduction. It's making sure that you plan ahead to capitalize on every single expense that you can take into account in that calendar year. So when you file your tax return in the following year, you've done everything possible to keep yourself below one of these two income thresholds, whether you're married, filing joint, or single. And that could mean the difference of not only an income bracket, right, dropping you from a higher income bracket into a lower income bracket, giving you the opportunity to max out deferred retirement, giving you the ability to make remodels happen on your rental investments, which decreases cash flow, dropping you into this lower income bracket and now qualifying you for 20% of your self-employed profit to be received tax-free. I don't know who in this on this green earth could argue with this as to being a bad thing, right? It is all about qualifying for these benefits. We have to put a plan in place to see where you land before the end of the year. It's very, very unique, very important, and we do a lot of planning here at Robert Hall, so always keep that in the back of your mind. I mean, aside from the tax preparation services, at Robert Hall, we offer just a number of services, anywhere from estate planning to financial planning, internal auditing, bookkeeping, payroll, business incorporating, you name it, we're pretty much a one-stop shop for all of that. For any real estate related comments, questions, concerns, we like to share the stage, obviously, with the professionals themselves. Marshall Reddick Real Estate, they are our go-to referrals for anything real estate investment related. And we love dealing with like-minded individuals because at the end of the day, real estate and taxes, they go hand in hand. It's kismet, it's a marriage of the two industries. We can help out their clients just as much as they can help out our clients. We're looking for every unique tax shelter in the book, and especially tax shelters that allow you to grow wealth. And what better way to grow wealth and shelter money than purchasing real estate? Real estate happens to be the #1 most common asset amongst the 1%. And if your goal in life is not to make a lot of money, you could be very happy with a couple rental properties paying dividends and stay very, kind of level with your income. But remember that the economy ebbs and flows. It appreciates, it depreciates. There are unique opportunities that arise. There are unique opportunities that are lost. And in business, I doubt that anybody is in business, literally grinding every single day in business to lose money or to break even, right? So the goal for us all is to utilize the tools at hand, to utilize the code that is in front of us that changes every other year or so. And we'll, once again, we'll come back with updated information, but to utilize the code to our benefit. Not to think of it as something that restricts us from doing things. That's the wrong way of thinking. The right way of thinking is seeing this set of rules, right? And implementing those rules to give you a major benefit on your individual return. It's the same, this is a silly example, but it's the same thing. My 2-year-old son, my wife and I bought him a little tricycle, and he rides it around in our house. It's got soft wheels, so when he hits the wall, it's really cute, and he loves the thing, right? And when it came from, I think, abroad somewhere, and it came in like 1 million pieces, and my wife and I dumped it out on the floor. We saw all of these pieces, and we're thinking, man, we need to put together these pieces. He's gonna love this bike. Let's just sit down one night and we'll grind it out. It might take us 2 or 3 hours to do it, but we'll do it. And then we open up the pamphlet, and the directions there gave us the ability to build it, not in the 3 or 4 hour time frame that we thought it was gonna take us. We built it in like 30 minutes together. And so you can't think of the Internal Revenue Code as something that works against you. You have to think of the Internal Revenue Code as that pamphlet that allows you to achieve a specific goal in a shorter amount of time. And as far as that's concerned, you could take that as you want. A lot of people don't like the IRS. I don't like paying tax just as much as my neighbor does. I know that it's important. I know that we all have to pay some sort of tax in life, but through proper planning, I cannot stress this enough, through proper planning, we can hit our obligated amount in tax and not a penny more than that obligated amount. Okay, I know that I'm going a little bit overboard. I did want to mention that we do offer these free consultations, people. So if you are interested in signing up for a free consultation, all you have to do is actually open up a smartphone camera, wave it over the QR code on the left side of the screen, or if you don't want to open up your camera or anything, you can text Robert Hall to 72000, and that automatically prompts you to sign up for a free initial consultation with us here at Robert Hall, with all of our senior advisors that are here and readily available to assist. It It is tax season right now. We are here until 2 o'clock, 3 o'clock in the morning, Monday through Saturday. We are pumping out returns left and right. Some of us are happy about the extended deadlines. Others don't really want the never-ending tax season to continue. But at the end of the day, I think that what they've done with the extended deadline is a good thing overall for the United States taxpayer. Gives us more time to gather information, gives us time to fine-tune those numbers. And through fine tuning, we can actually achieve a greater goal. We can retain more of our wealth by just having a more organized plan in place. So keep that in mind. I want to switch this back over. Thomas, I think you had a slide that you wanted to show us all, correct?
Not necessarily, just a contact information one last time. But no, we could share that so everybody can see. Thank you for everything today. That was phenomenal. This is why we like working with professionals, because even in the presentation today, I learned something that's directly applicable for one of my clients that I'm working with. From a situation we ran into today, and I was like, don't worry, I'm doing a webinar tonight. I'll probably get the answer for you, and you answered that question. So thank you much, Tony. It's greatly appreciated.
Absolutely, and I'm gonna go ahead and stop showing my screen so you can show your contact information once again. If you want to just show that to everyone in the webinar, our company names are pretty easy to remember. You can always look online and find our connection information, and if you reach out to Thomas or anyone at Marshall Reddick, they have our contact information readily available. So if you ever want to know who those crazy tax people are that hopped on the webinar, you can always call them and grab our contact information as well.
Somebody has to be excited about taxes, right?
Hey, somebody's got to do it, and and in my world, it's always a good day to be an accountant. Teaches you a lot about a lot, and I wasn't a huge chess player in my life, but as I've gotten older, I've really enjoyed playing chess, and it's become a real fun pastime for me. And tax planning is very similar to chess. It's strategically moving your money around to essentially achieve the ultimate goal of paying your obligation and not a penny more than the obligated amount. Romar asked Thomas, what's the link again? So I think Romar, we answered that one. Jose Sandoval, thanks for the question. I own 2 rental properties. Does it make sense to incorporate? So the 2 rental properties that you own, you really have to take a step back and look at what kind of equity you have in the properties, the types of tenants that you rent out to, what kind of level of liability you have with them. Are they elderly? Could they injure themselves easily? Are there children involved? Could they get sick from mold damage? I mean, there are a number of things that you have to kind of take into account. I wouldn't suggest right out the gate starting the LLC. I would suggest actually talking with a legal professional first and foremost to see if that legal advisor thinks that your 2 properties, value-wise and risk-wise, warrant the need for an LLC, one LLC, or multiple LLCs. I individually have my properties set up in LLCs because I have good equity in them, and I realize that I want them individually separated from each other, and so I'll pay the annual filing fees for the LLCs and whatnot, and that's just a cost of doing business, but I have peace of mind that I do have that added layer of asset protection. So I don't want to tell you yes, I don't want to tell you no. I want to say, and once again, I don't like this, but it depends. We would really have to take a look at a couple outside factors kind of playing into these 2 properties to really advise you in the best way possible. Okay. Rick Stewart, I hear Biden is considering eliminating step up in capital gains, make it regular income upon inheritance of property. What have you heard of the likelihood of this happening? I've heard very similar concerns and speculations about those. There's a lot of things that are put out online, that are put out in chat rooms, that are talked about in the media. I am not a speculator, and I know that people really like to look to the news media outlets for some sort of information. And if 2020 taught us anything, it's that the media probably will say anything to increase ratings on both sides of the fence with any media station. But I think that the best advice you can get is from a licensed tax advisor, which is me and any one of my senior preparers here. We've studied the code long enough to know that getting rid of something like the stepped up basis completely, getting rid of or abolishing the 1031 exchange industry, that is a very short-sighted thing to do. Those industries, those benefits create millions of dollars, billions of dollars in wealth for the United States taxpayers, which creates more opportunity in buying and selling and flipping and doing all of these things with real estate. So, and it also ends up, the trickle down effect impact, it ends up creating a lot of jobs for the US economy, especially the exchange community. So I don't think that they're going to get rid of it. I think that they may end up phasing it out for high income earners in the 1% or higher level income brackets, because I think the Biden administration really is trying to focus on the wealthy of America. They're trying to focus on the individuals who have millions and millions, if not billions of dollars, right? For the individuals who are under, we've heard this $400,000 number thrown out a lot. For any individuals who make under 400K, I don't think very much is going to change for us. I'm not saying that nothing will change, but I think that we will be, it will be interesting to see what actually gets pushed through. I do not think the stepped up basis will go away. I think that they may alter it, but for individuals who are middle income or lower income individuals, I think that will stay around. I hope that I am right. Right? Because once again, that is a little bit of speculation for you. I don't like speculating on things. I like waiting to hear final verdict on something, and then I start my advising position based on facts, not speculation. So we just don't know yet, and Biden will be rolling that out over the next 8 to 10 months. Is it possible, Zhaopeng, is it possible to move all my investment properties titles are correctly under my name into a corporation? Well, remember what I said, you don't want to move your properties into a corporation. You want to move your properties into LLCs. LLCs are not corporations, so I want to make that very, very clear. You do not put rental investments in S corporations. You do not put rental properties in C corps. You only put them in limited liability companies. And you can call an LLC a corporation if you want. I mean, if that makes it easier for you to understand, as long as you know that LLCs and corporations, they are not the same type of entity. Is it possible for you to move all of your investments over to an entity structure? Absolutely. Quick claiming of deed is pretty darn straightforward, but you want to take into account two main things, probably a couple other things that you want to take into account, but two main things. One, you want to make sure that when you transfer title that you're not adding anybody else to the ownership of the new entity that you're transferring it to, because that could trigger a reassessment of property tax. So the ownership has to stay the same. If I own a property outright, I transfer it to an LLC. I have to own 100% of that LLC in order for there not to be a reassessment of property tax. If I transfer it into an LLC that I own with my son or with my spouse should be fine. There are special forms that you could fill out at the county assessor's office to avoid any reassessment. But there are a couple factors that you have to take into account on the property tax side of things. You also need to be aware of the fact that if there is debt attached to the property, the lender loaned you the money, not your LLC. So if you transfer a property from your personal name into an LLC that has debt attached to it, and the lender finds out for some odd reason that catches wind of that transfer, the lender could call the loan due and payable in 30 days. And that is terrible. You don't want that to happen. In most cases, I've never seen that in 17 years that I've worked in the tax industry, but have I heard it happening? Yes, but not with any of my clients. And so once again, you want to make sure that your lender is okay with the transfer. You want to double check with them that everything's kosher, just so that you don't put yourself in a financial obligation. Heaven forbid they do end up calling the loan due and payable in a certain period of time. For Satish, since I have mortgages, the banks do not allow properties. There you go. Next question. Do not allow properties to be transferred to LLCs. How does one overcome this issue to have liability protection? Well, great insurance policies, number one. Number two, if you qualify for a refinance, most banks will happily refinance your properties into LLCs as long as you hold a personal guarantee against the debt. And so you'd probably have to look in this case, if you're working with a specific bank that doesn't allow it, that is just that bank. I know that credit unions in some cases are able to maneuver a little bit more. They have a little bit more flexibility. They have a little bit more power and lending capabilities, but so do the bigger banks. I know that Merrill Lynch, for instance, Merrill Lynch has an asset lending division where they'll look at all of your assets, your brokerage accounts, your 401ks, your profit sharing plans, your cars, all of your assets, and they'll actually loan you money based on the value of your asset portfolio at very low interest rates. So once again, creative financing is always kind of the unicorn of the tax industry and the real estate industry. And I'm sure that Marshall Reddick has a number of referrals for the lending side of things. If they don't, I'm sure they do, but if they don't have any creative financing, we have a number of people who you can talk to as well. We're all in the same network here. So, and I'm sure that Marshall Reddick will have somebody available for you to talk to, but it could take a little bit of creative financing in that particular situation to get the job done and get those properties moved over to an LLC. Harry, do you have recommendations for the right insurance? I mean, I use Farmers for everything that I own. In Texas, it's an independent agency. Off the top of my head, I don't know the name. You know, it's direct debit, so I'd have to check to see. I think their name has changed over the past year that the agency was bought out, but it's a smaller independent agency in Texas. But for my California properties, for my California, cars and everything, I use Farmers. But once again, you probably would also want to check with Marshall Reddick to see in areas where they invest what the better insurance companies are to go with, because they have foot soldiers in different parts of the U.S. Their arms are stretched out much wider than mine are in the real estate industry. I have clients in other states, and I could very much call them up and ask them, but it really all comes down to an insurance company that understands your specific structure and knows how to custom tune some of these policies to protect your individual asset, not just a cookie cutter policy that protects real estate in general. Okay. Another question from Harry. I mean, what company? So yeah, Farmers is mine here in California, but elsewhere you probably want to ask Marshall Reddick if they have any referrals elsewhere. Do you have a recommendation for a real estate lawyer or prepaid legal services? Mark Prado, we have a number of attorneys that we refer to. So does Marshall Reddick. I would suggest probably reaching out to our marketing department. We have attorneys for all different services. I mean, we have the Harigi Law Group for litigation services. We have Michelle Maddie for estate law and trust law. We have a number of attorneys who are readily available to assist across all levels and individually unique, in their individual practices because they specialize in different fields. So you can absolutely reach out to our office or Marshall Reddick Real Estate and see if they have any good referrals for you as well. Is there a restriction, Madhuri, is there a restriction of where the LLC is registered? Well, you can register your LLC anywhere in the US for greater asset protection benefits possibly, but if you individually reside in the state of California, California will absolutely want you to continue paying their $800 annual filing fee because you are a resident of California and California taxes its residents on their worldwide income. Okay, so just understand California is a very unique state, and I'm sure that people are yelling at their screen saying, darn you, California, but at the end of the day, we pay for the sunshine here, pay for the earthquakes, pay for the rain, seldomly pay for the rain, pay for the parking ticket. I mean, we pay for all of the luxuries of being California residents. So why not get hit with that $800 filing fee, even if our LLC isn't in the state of California, right? There are there are some people out there who say that they can get you out of paying that by setting up structure certain ways. The only way that has been tested is through a land trust set up out of Delaware, and then the land trust owns the LLC. There are very unique ways through land trust that you could potentially avoid that. But you may be looking at additional filing fees that are actually greater than the $800 initial fee that you're going to be paying. So once again, very unique structures set up that way, and also a unique conversation to be had with a tax advisor or a specialist in the land trust field to make sure that that's the right option for you. Okay. Ramar, Thomas, what's the link? Oh, so Thomas put the link on the screen there. Javier, thanks, Tony. That was great. Good. Hey, thank you, Javier. I'm glad that you enjoyed it. Absolutely. Ramar, absolutely. You're very welcome. Howard, in the S Corporation 60/40 example, what happens to the other 60K left over profit? Is it something you have access to as an individual, or is it kept as company profit? So S corporations are considered to be flow-through entities. So any money, any profit, which in this case is 60 grand, any profit that is left in the business is yours. You can access it doing owner draws at any given time, and that is not subject to tax upon transfer, because remember that the $100,000 example that we gave, no matter how you split it, when you add the W-2 and the K-1 profit up, it still equals 100 grand in profit. So it doesn't matter how you split it, you're still going to pay federal and state tax on the full 100 grand. So naturally, if there's 60 grand left in the business, you can draw it to your personal account because you're going to pay tax on it anyway. It's just the benefit here is that you're not having to pay Social Security and Medicare tax on the 60 grand. So that's what you're avoiding because you are controlling the amount of self-employed payroll or employee payroll, which is the only amount in this situation, 40 grand, 40% of the profit. That is the only amount that is actually subject to Social Security, Medicare. The 60 grand is not. But when you add them both up, you still pay federal and state income tax on the full 100 grand. So hopefully that answers your question. Doris, what is the best way for asset protection of primary home? Primary homes should not be put in LLCs. They should be putting living trusts to protect you from probate, but there is no need to put a primary residence in an LLC unless you live in a home, but you also travel a lot. So you have maybe renters living in your house, you Airbnb it. Very unique situations where a property part ownership should be under an LLC. I don't find that to be very common, but once again, there are very unique situations where that could actually be a play overall in the grand scheme of things. But definitely putting it into a living trust or some type of trust or estate that protects your primary residence from probate here in the state of California. Harry again, what if my rental properties are in out-of-state Kentucky? Do I form LLC there or here in California? I would suggest setting up the LLC in Kentucky because that's where the asset is. You need the limited liability protection in the state that you own the property. But remember, California gets you at every corner. They say, okay, well, you can set up an LLC in Kentucky. You're still going to pay your $800 filing fee to the state of California. That is the premium. I call it the CA premium, the California premium. The Golden Coast premium, the Golden Coast prepay, the copay that you essentially pay for living here in the state of California. California hits you at every angle. They are one of very few states, I think there's 7 or 8 states, that taxes its residents on their worldwide income. We're not only talking about domestically, we're talking about internationally as well. So they tax you on everything. And if you pay tax elsewhere, yes, you might get a credit on your individual return for what you paid elsewhere, but you will still have to settle up with the state of California if this is the state you individually reside in. Okay, so once again, you could set up the LLC in Kentucky. That's where the asset protection is needed, but it doesn't negate the $800. It doesn't avoid the $800 filing fee here in the state of California. Francis, in a class, I was advised to create an LLC in Nevada, regardless of property location, as it is more cost effective. Have you heard of this? Well, yeah, I mean, it's cost effective, but was it an attorney telling you to do this? Or was it just a business coach? When you talk about entities, the number one benefit before any tax benefit, before any, any other benefit that you foresee having under an entity structure, the number one benefit should be asset protection. And so if that person advising you was not an attorney, they were looking to just tell you, hey, yeah, it's gonna cost less to file in Nevada than it does in California. But guess what? What they didn't follow up with is that, well, hey, in order to get this benefit, you physically have to live in Nevada. You physically have to live there in order to avoid California filing fees. If you live in the state of California and you have a Nevada LLC, guess what? Your Nevada LLC has to file for foreign jurisdiction in the state of California and still pay the supplemental $800 minimum filing fee because you reside here personally in the state of California. So yeah, you got to be very careful the advice that you get in classes. If they're not licensed tax advisors, if they're not attorneys, you got to make sure that you're dealing with individuals who are licensed professionals. Now, I don't know the exact conversation there, so maybe there was something else that I'm missing out of that conversation that may make that possible, but I don't really see any other angle except for you physically moving to Nevada, to be honest with you. Winnie, oh, well, thank you. Yeah, well, I'm glad that you enjoy our seminars, and yeah, I mean, I share the stage with a lot of great speakers like Thomas and all of the other vendors that Marshall Reddick Real Estate and Robert Hall share. We really feel privileged to be able to bring this information to you on a weekly, monthly, yearly basis. So thanks for joining. Let's see here, with a out-of-state Wyoming holding LLC, Georgia subsidiary LLC, the holding LLC is 100% member. Do I have to file an out-of-state Georgia personal tax? If so, is there a way to file it a business entity, a personal tax? Basically, I want to use an entity to file tax. You know, that's a really kind of a complicated question. I mean, if it's 100% owner, the only time that you would ever have to really file in another state is if one, they required it solely because you're an LLC. Or 2, if the profit allocated to that state was over the standard deduction in that state. I know that there are very unique codes in other states like Massachusetts, Wyoming, Delaware, Wisconsin that require certain filings, but in most cases, it really all depends on how much earned income is there. You may have to file there, but there is no tax implication there. And I actually, me personally, I normally with my own taxes, if I own an asset in a different state, in most cases, I might just roll the dice and not file. And if the state asks me to file a return, there's no taxable income in that state. So what are they going to do? They're going to ask me for a zero return because they're fishing for additional tax revenue. And when I send them the return and it's a negative income after depreciation on the property, mortgage interest, property taxes, so on and so forth, they're not going to get anything out of it. And as far as a late filing fee, I could say that because the profit was under the standard deduction, there was no requirement for me to file. Now, if I own a business in that state and I don't pay the filing fee for the business, that's a different story. So if you're talking about income tax, it really all depends on what state, number one. Number two, is it based on an LLC? And if Wyoming has an actual LLC filing fee based on assets that you own under the LLC, based on shares under a corporation like Delaware does, Delaware assesses its filing fee based on assets or par value of shares issued to shareholders. So if there's a unique part of the code in that state, you may actually end up having to file there, not pay any tax, but still end up filing something in that state. I'm only going to answer one more question, guys. You know, it's getting pretty late here, and so I want to make sure that everybody, you know, I think we answered a lot of questions here. I do want to push you to really sign up for these free consultations too, and to get that one-on-one unique consultation. Last but not least, Martin, this is the best presentation I've seen that you give. Thanks. That wasn't a question, so I'll go on to the next question. Thank you for the comment, or oh gosh, it's getting late. Thank you for oh gosh, my mind is fried. Thank you for the comment. That's all I can say. Doris, can living trust protect my primary home from lawsuit? A living trust will not protect you from potential lawsuits, but it will protect you from probate. And I guess it really all depends on the type of trust. A living trust, no. But there are other specific types of trust that may protect you from debt collectors and debtors and debt collectors. So that, because I'm not an attorney, I probably wouldn't be the professional to answer that question. I apologize. That would be more of a question for a legal advisor. So I'd really have to defer that question to our legal team. I can tell you right now that the living trust gives you great asset protection from probate court, which is just the state of California essentially trying to get their sticky fingers on the assets that you've worked your whole life to obtain. So it really all depends. And it depends on the type of trust. Not depends in general, but depends on the type of trust. And I do believe that there are some legal benefits, especially from the debt collector side of things, for specific types of trusts, but you got to talk to an estate or a trust attorney about those specific details, okay? All right, everyone, thanks again. I know that we went about 21 minutes over. I'm glad that we were able to retain most of the audience. Thank you so much for staying in there. I know that it's late. Everybody wants to get to bed or start eating some dinner if you haven't already. Thank you, Thomas, for sharing the stage and always for sharing your great referrals and vendors with us. We really appreciate it, all of the events that we get to do with Marshall Reddick Real Estate. We look forward to our next one, everybody. Have a great night, and do not hesitate to reach out with any questions. Stay safe and take care.
Thank you, guys. Good night.